morning, everybody. Welcome to what I think is going to be 2 great days. And since Christmas is coming pretty soon, there is a host of gifts that you can buy at this conference over the next 2 days, particularly if they're in the gold sector, and I'll go through a bit why. I was trying to figure out how to start this, and I saw a clip. I am a massive Buffalo Bills fan, nice to see us beat Kansas City. But there was one play in that game that I think describes the market today. The Bills have a defender called Nick Bosa, and the play opens up where Nick goes forward, and it's just him and Mahomes, the quarterback for Kansas City. And he stops because he realizes this is the easiest sack he'll ever have in his life. There must be something wrong. And so he actually stops, figuring, well, this has to be a trick play or something has to be wrong. And rather than doing the obvious play, he stops, looks around for a little bit, and then he continues forward, which allowed Mahomes to complete, I think it was a 4th and 17. The market today is giving you an absolute gift, in particular in terms of gold and what the market is saying to you. It is not a trick play. And I really want to go through why we have a very high gold target. 10,000 is a number, but we think the trends behind it show you how we can get to a number like that. And it's not really a trick play. I think what's going on in the markets today is pretty straightforward. So let's go through this. There we go. 2026, I think, will continue to be what 2025 was. A lot of chaos, a lot of volatility, but a lot of opportunity. I think the market continues again to think we're in a trick play, that the US government's constant tariffs and trade wars and sounds like now real wars is just a blip onto something that will get into something quote unquote normal and calm down. No. This US administration wants chaos 24/7. They want to be on your news feed every second of every day, and that will continue for the rest of this term, whenever that ends. And so that is something that's really important to understand. This won't calm down ever. That will lead to extremely high volatility in markets. And I think we're starting to get into a bit of a choppy part, but expect extreme volatility. And when you see extreme volatility, obviously, that gives you great opportunity. But let's go through with this a little bit more. There's been a lot of talk of what we call about de-dollarization. There are a number of plays here that the US government in particular are trying to do, and none of them are congruent. They're very at odds with each other. And that is going to cause, and what we have seen already cause, the rest of the world to say, if the US wants to go home and play in its own sandbox, then we don't have to play with the US, and we don't need their dollars. And so you've been seeing a long-term trend of dollars being used pretty much less and less for trade and more using other things. And so I think this is interesting. What this chart doesn't have is actually gold, because the currency that the world is heading towards is gold. And there's absolutely no question about that. Before the trade war, these were the numbers. And this shows in the blue line, the percentage of currency used in trade, the orange line, the actual share of global GDP, and the third line, the green line, is actually the share of global trade. China being the one that was the big outlier, very little yuan have been used, although the Chinese are really starting to pull their weight here on trade and increasing the yuan. Note that it's been a policy of China for the last 25 years to build its gold reserves as quickly as they possibly could. Now, the deal that the US has had with the world over the last 100 years has been pretty simple. We want to lower tariffs to increase trade. When you increase trade with us, you need more dollars. You take those dollars and you invest it back into the US to pay for the US ever-burgeoning deficit. That's been the trade. And by buying our deficit, you keep our interest rates low, and then militarily we'll protect you. It's sort of been the deal for the last 100 years. The new administration has said all of that is completely wrong, and they're trying to reverse all of the last 100 years as quickly as they possibly can. Now, the world has responded by, one, selling their treasuries, but they haven't been selling dollars as of yet, which is really interesting when you see a chart like this, because it shows you there still has a lot of room to go. What is the green line? That's pretty much investment in US AI. So all of the trillions of dollars that are going into all these AI investments in the United States, they're using dollars. But as soon as you see some cracks in the market, the green line will start to come down. And again, where does that money go? It's going to gold. Now, we have seen this last, really since 1972, whenever the dollar has been weak, the price of gold has been strong. And this year, even though we've only seen a 10% decrease in the value of the dollar, this is the DXY, global currency weighted dollar, and that was about a 50–60% increase in the price of gold. President Trump has said over and over for many years he wants to see the value of the dollar about 30–50% lower than where it is today, and they're going to get there. How are they going to get there? First of all, they're going to destroy the US economy. The tariffs imposed by the United States are the world's largest single tax increase probably over the last several hundred years. This is how much. This is by the Yale Budget Lab. This actually doesn't even include the big tariffs that China had that the US had imposed on China. So this is a real number. There's about a 20% tax going on in imports. And in the US, you can see this in your stores. You can see the price of everything going up. You talk to auto parts suppliers or people all around industry saying, all of their costs are up 30, 40, 50%. And that is absolutely crushing the US consumer. The US consumer is the driver of the world economy, and if you take the US consumer out, it's pretty bad news. This is showing up in the University of Michigan Consumer Sentiment. We don't see a lot of data out of the US, but you can see that the sentiment data had been in the 70s to 80s. Now it's around 50. Below 50 is considered that we are in recession. And I would fully expect that the US, either at this moment or very shortly, will go into recession. You're starting to see, as the US goes into recession, and obviously that means less tax receipts for the US government, the US debt is rising. And the US, what we've seen is where the US used to have a far lower debt as a part of GDP than, say, other parts of the world like the Eurozone, now the US has soared. So again, think about the linkages of the world. We trade, you take our money, those dollars, you invest it into our deficit. The deficit continues to rise, but the use of dollars continues to go down. There's a problem. Now, what has the US started to do about this? They've started to print money. And you can see in this is M2. Now this is for the world, and the US has been part of this, has really started to crank up the printing presses in order to pay for its deficit. Now, a lot of the rest of the world has deficits as well, and so you're starting to really start to see this in the data about M2 coming out, huge increases in money supply. And then I talk about real person inflation. If you look at a lot of the data that's been coming out of the US, and again, I think what happened was Trump introduced these tariffs, which were absolutely massive. The market tanked. And then, well, it was 3 weeks later, and the data doesn't look so bad, so everything must be normal. Again, the first reaction was the right reaction. The tariffs are incredibly devastating. And I didn't put it in here, but HSBC, I was at the London Metal Exchange. I gave a speech on copper, and they were showing how the tariffs have actually worked its way through to the consumer. It took a long time. Most of the time, most of the companies were eating the tariffs in the early few months, and then at a certain point, they're like, we just can't do this anymore, and you're starting to see it pass along. And they believe by the end of this year, about 80 to 90% of the tariffs would be passed through. And again, that's going to, people talk about transitory inflation. That makes no sense. I raise your cost 20%, all of a sudden I have no money, so I'm going to go and demand more salary. And therefore, that starts the inflation move. It's not going to be, I'm going to take a 20% hit to my salary and be happy with it. It will be passed through, and this will not be transitory. And you're starting to see this. Why has U.S. inflation only been 3%? My father's favorite phrase, which I love to use, is figures don't lie, but liars can figure. If you look at the U.S. data, it's housing. The price of U.S. housing has been dropping. How often do you buy or sell your house? But the huge drop in U.S. pricing, because houses aren't just being sold today, means that inflation overall is stated about 3%. But if you look at real inflation, things like beef up 30% year over year, things like electricity up 30% year over year, things like appliances, et cetera, up huge. What you live on day to day, that inflation has been soaring in the U.S. and obviously hurting the U.S. consumer. Now, this was really interesting. The U.S. Fed actually in September published a study about gold's purpose in the world. I come from the 1990s where the Wall Street Journal said gold was a worthless metal that would never be used again, and it's just a relic of the past, and it's only used for jewelry. Now you have the U.S. Federal Reserve putting out a major paper saying gold has a huge impact on the world, and we need to really understand it and study it. If you look at central banks' balance sheets around the world today, their number one holding is obviously the U.S. dollar. Their number two holding is gold. And the reason why gold has been gone to by central banks around the world is, imagine if everybody said, okay, the US is pulling out, we have to sell our dollars, we have to buy another currency, let's buy euros. Okay, then if all of a sudden the stat comes out that central banks have increased their euro holdings by 15%, Trump is going to come out and put a 400% tariff on euro for people trading the euros. Or if it was Japan or Switzerland or any other currency. Gold, there's nothing for him to attack. He's actually a bit of a gold bug. So central banks are a knife-safe place to use currency is gold. And remember, 2 years ago, the Basel III Accord came in, which takes gold at a 100% valuation rather than the prior 50% valuation. So gold is a perfect currency, and central banks are going there in a very strong way. Not only are they going there in a really strong way, but a lot of countries around the world continue to produce gold reserves. They are taking those dollars and they are putting them into gold. And if you look at the share of international reserves, and again, this stops at I think this ends at 2024, you can see how this is going on, where central banks are saying, okay, dollar, you're not needed anymore, gold is going to be it. And I think you'll actually start to see either gold-backed bonds or gold-backed currencies come into fore over the next few years as people sort of say, okay, you don't want to trade yuan, how about a gold-backed yuan? Things of that nature, I think, will occur. The last part of this is, it's interesting, what the Fed calls de-dollarization isn't what investors call de-dollarization. To the Fed, de-dollarization is, I am purposely getting rid of all my dollars to buy other currencies or gold, and they put Russia and Turkey in that part. Whereas China, which obviously is de-dollarizing, they call that substantial diversification. And I really don't know the difference between the two, but you are seeing that the world is just turning away from the US dollar. Now, this leads us to gold and leads us to Christmas. The price of gold has rocketed higher. And this shows the Bloomberg juniors and the Bloomberg emerging gold miners on an EV to reserve and resource basis. They have not moved. I understand a lot of the stock prices are up 100%, 150%. But if you look at history, these are the cheapest gold juniors and emerging companies have ever been, probably back to 1972, when the US went off the gold standard. They are ridiculously cheap, and the market is not seeing that. Now, could it be it takes a while for the market to realize that $4,000, $5,000, $6,000 gold is actually here to stay? Probably. I always say, if you think this is a fluke and $4,000, we're going to go right down to $3,000, well then hedge. It's very easy to hedge out gold to $5,000, $6,000, $7,000 over the next 10, 15 years. Of course, no one will ever do that. But if you're so certain that the price of gold is going down, just hedge it, and all of a sudden you have immense cash flows coming in, guaranteed. But I do think because of all these tailwinds we're seeing, that the price of gold will continue to go higher. It won't be steady step. If you look at the last two gold markets, they were 7 years. The 1972 to 79 gold market was up 1,800%, so 18 times. The bull market of 2000 to 2007, the price went up 6 times. So when the price was around 3,000, and I put a $10,000 price target, and everyone goes, oh, 10,000, that's just so crazy. That's 3 times. If it was 6 times, then Dave would fall off his chair because I would say $20,000 gold. But this is, everyone's looking at the number, not the percentages. And the percentages tell you historically that the gold bull market has to go. And again, this is a game-changing time in economic history. It's changed. And I think it takes a long time for people to understand it has changed, because no matter what, anything the U.S. administration does going forward, the trust that the U.S. had with the world is gone. And it won't come back anytime soon. So this change that's occurring now is done. We're moving in motion. It is not a trick play. What you see in the marketplace is actually real, the change of the world economy. So don't be Nick Bosa. Now, I also want to talk a little bit about AI and demand. Base metals, precious metals seem pretty good. I don't spend a lot of my research on silver or the PGMs. I'm too stupid to understand those markets, but what I do know is that they follow ahead of gold. So if gold is going to go up another 200%, it's good news for the other precious metals. So I think precious metals you put in one camp. Base metals become a little bit more difficult, and this was my speech at the LME, which people weren't terribly happy to hear about, because I think copper is going to have an incredibly volatile 2026, and then I think the copper bull story really takes hold. Why? Electrification. What is going on with AI? And my old shop, McKinsey, has the world investing $7 trillion in AI over the next 5 years. That's 1.5 times the US budget. Unbelievably massive amount. And the unintended consequence of AI is really on battery materials, copper and lithium. Why? NVIDIA just put $100 billion into one of the big AI firms to build a series of server farms. The first server farm they build will use more electricity than New York City has ever used at their peak. One server farm. Spain was building the most AI server farms in Europe. Their grid went down. The US is building hundreds of server farms right now. Price of electricity in the US is up about 30% this year. AI is the biggest, what AI basically is a gigantic chunk of metal. This large server farm that NVIDIA is building is 200,000 metric tons of copper. They are just gigantic chunks of metal with a lot of electricity. That will destroy your grid. Now, it's funny, at the same time that everyone needs electricity, you can see China building the world's largest hydro project. I think it's 10 times bigger than the Three Gorges Dam, and is building solar and wind and everything they possibly can as fast as possible. They also realize that that's not enough. And so what they have to do is build, I would call them electricity lakes. We used to have data lakes, well, they have electricity lakes. You need gigantic stores of electricity for these server farms, because as you go throughout the day and there's variability in your electricity demand, it can take down your grid, which it took down Spain and Portugal. So what you need to do is build these massive amounts of backup storage, and batteries are the way to do it. And so you've seen China, which again moves much faster than any other country in the world. They announced a 2.5 trillion yuan emergency order for backup batteries to be built within the next 24 months. That started to come into play this year, which is the reason why we turned bullish on lithium probably before anybody else, because you need an awful lot of lithium, and the numbers coming out of China were showing us that. But expect AI to really have devastating impacts on countries who are really big in it, and expect the follow-on. And I was in Spain, I had to give a keynote in Lisbon, Portugal, and there was Spanish and Portuguese and a lot of European officials, and they were like, how can we quickly build this stationary storage to have backup power because our grid is too close to failure, which theirs actually failed. So that is going to be a really big thing. Numbers are huge. I mean, this is over a year old. Doubling in transmission equipment. All the signs to support AI are just unbelievably massive numbers. And so that is something that's going to be huge. And the battery technology that we're seeing coming on does use a lot more lithium and a lot more copper than people think. And if anybody asks me about sodium ion, I am not a big believer in sodium ion batteries. They are not salt. They are a lot more than salt. They're things like titanium, lanthanum, very niche metals to actually make a salt battery work, and there's not a lot of those things, so don't worry about salt as much. And here's what we're talking about. Production in China has just exploded. LFP batteries, which are the batteries you use in stationary storage, almost doubled this year. Last year, stationary storage was up 200%. This year, it'll be up 100%. Next year, it's probably up another 100%. Huge, huge growth here in battery demand. And what does this mean? Huge growth for overall batteries. And why did most analysts miss the lithium move? Mainly because they weren't thinking about stationary storage as a real market. In 2020, stationary was only 8% of the size of electric vehicles. This year, it's over 60% of the size of electric vehicles, and probably will be the same size of EVs within the next decade. So this is something, and again, I don't know where the next battery surge is going to be. Will it be robots? Will it be other sorts of things that use huge amounts of batteries? I don't know. But stationary storage is something, because if the grid does become so brittle, everybody's going to want, not just for backup power, every industrial plant's going to need power, every residential is going to want more of this. So you're going to see batteries in so many different uses, and that's really causing the huge spike in supply and demand. And battery technology is changing as well. I mean, look at these numbers. In 2024, the best battery pack in the world was Tesla's. They had 3.9 megawatt. Fast forward 1 year, CATL has 9. And then if we go fast forward to next year, LMFP, manganese, which is my favorite battery, new material, you can actually go up to 18 megawatts. So these battery packs are becoming much more condensed. The costs are going down drastically. And as the cost goes down, you open up more opportunities for sales, which is why, again, you're seeing these huge increases in sales in the stationary space. And one last thing, just before I get into my conclusion. Black swan, you probably heard of private credit. And if you look at these numbers, I just want to see, all right, I hear in the news that private credit is out there. It's unregulated. You've seen some of these private credits implode over the last few weeks, causing some bank stocks to fall drastically. One of the volatility things I can see is private credit was about $250 billion last year. It's on target, and this number, someone had told me this is conservative, will be $1.3 trillion in private credit this year alone. This is all unregulated. If it fails, there's no one there to back it up. The banks are going into these things. Just be nervous, because whenever financial institutions have creative ways to put money into the economy, it hasn't turned out well. And this type of explosion is something just to have at the back of your mind. This is something. And again, this is very positive for precious metals. Were we to see another crack in the financial system, again, gold is sort of the one thing people rush to all the time. So, in conclusion, more trade chaos. Mr. Trump wants to be in your feed every second of every day. That will not stop. And you never know where it's going to go. 50% on Brazil, because he's pissed off a friend of his is going through a trial. 50% on India, for whatever reason, they're buying the wrong oil. And yet he doesn't go after China for buying even more oil from Russia. Interest rates, looks like they're on hold for now, although Trump wants them as low as possible. Again, a way to reduce the value of the dollar is to drop your interest rates. We do expect the dollar to decline. Trump wants it down 30 to 50%. We think we can get another 15% next year. All real positive, because since metals are priced in dollars, a decline of the dollar is a positive to the metals. Watch for the U.S. elections. They're actually today in the U.S. It's a small. There aren't too many main events. New Jersey is going to be interesting. It's traditionally a Democrat state, although it flipped to Trump in the last election. Let's see what happened there. But next year is the midterm elections. That could be something to slow down the Trump train. If the Democrats took something, right now they're completely out of power in every part of government. Worry about the AI. Is it a bubble? Obviously, it's a bubble. Best bumper sticker I ever saw in my life was, "Dear Lord, give me one more bubble." Well, we have one, and we always will have them. But the pop of this could be bad. Metal prices be volatile. If you do see something really start to fall hard, if copper were to go back to 7,000 or 8,000 because some really bad U.S. economic prints, great time to buy. Because I think the long term in there is really, really good. But don't be surprised that it goes down to 7,000 or 8,000 because I do think the volatility is going to be super high. Lithium, I don't think we'll see a boom in lithium prices, but I do think you'll see a steady recovery of lithium prices as this major build-out of AI continues. It probably really takes steam towards the end of 26 and 27. That really is when copper is going to be huge. And again, for any, put up a newspaper of every gold company, PGM company, silver company, throw a dart, you're going to make a lot of money because this is going to be an epic bull market. We're 2 years into a 7-year cycle.